as I kind of moved on with my career, I kind of got more and more complex with my analysis. I added in lots of new fancy indicators. I was always on the search for new indicators, and my analysis got more and more and more and more complex. And then what I realized is when I then started to break down that analysis, I realized that I was doing, and there's the phrase, paralysis, analysis paralysis, right? And I was just doing so much over analysis that I was getting too many conflicting signals.
Welcome back to Episode Down with Steve Miley. Steve, welcome to the podcast. Good to have you here today.
Yeah, good. Thanks for having us on. It's a real pleasure.
My pleasure, of course. So looking forward to discuss with you about technical analysis and kind of what you've done in the past, what you're doing now these days. But let's go back in time a bit and tell me kind of how did you get involved in trading in the first place? How did that all begin?
Oh, wow. Now, how much time you got, right? I think it's a really good story. I really like this story. Well, it's not a story. It's my life, right? So, from a very young age, I tell you where this came from. I come from the East End of London, which is kind of the rough area of London, right? And I grew up there. I think I always, from a quite young age, wanted to get out of there. And eventually my parents did move out to the suburbs. But people used to ask me, and this is not a lie, when I was 11, 12 years old, what I wanted to be. And most boys were saying, I want to be a footballer, or I want to be a policeman, or, that kind of stuff. And I used to say, I want to be a millionaire. That's what I used to say. And I know a millionaire is not very much these days, right? But that was the equivalent of saying billionaire today, right? So I used to say that. And I had a real sort of thoughts and plans about how to do that. And part of that plan was I was going to make some money. I was going to save some money. I was hoping to save between 10 and 100,000 pounds. And then I was going to invest it over 10 years from in my 20s. And then and that's how I was going to do it. It's through investing and trading, to an extent, I guess. And I didn't even know it then that's what I kind of wanted to do. And then fast forward to my teens, and this is before your time, and I don't expect you to know about this. So this is in the mid-80s, early to mid-80s in the UK. They did what was called selling off the crown jewels. So what they did is the Conservative government at the time under Margaret Thatcher decided to sell all the industries that were owned by the government, the nationalized industries. They decided to sell them off to whoever, right? So it was to the investing community. But what they wanted to do is they wanted to have it go to the public. So the public could buy so it was buying into British Telecom, British Gas, into the rail networks, all these kind of things. And that was my introduction to financial markets at 14 years old. Now, you weren't at 14 allowed to apply, but you could apply. Well, you could, but you had to buy as a proxy via my parents. So basically, I kind of had some savings. I was working 3-4 jobs at that age, 14, 15. I had a Saturday job. I had a paper round, and I'd saved some money. I'd about £1,000 to my name, I think. And I just put it into these stocks. So that's stagging the market. I think it's still called stagging the market these days, which is just basically being involved with an IPO, right? So I did I did those. They did them every 6 to 9 months to every once a year. You could do this. So I did that for 3 or 4 times, and I tripled my money in the space of a year or a year and a half. And I kind of got the bug, and then there was no internet obviously back then, so I was actually cutting out coupons from the Sunday newspapers, the financial pages of the Sunday newspapers, sending away to things like investment trust and books on. It was mostly investing then, because trading back then wasn't a thing. It wasn't a thing that was accessible to the man on the street, to the retail trader. So that was kind of my induction into financial markets, before I was even 18 years old, initially with this dream of investing and turning making my capital work for me. That's always something that's been very important, not to be lazy with money, really. Don't just have it, I would never be the type of person who would have it just sitting in there in a bank account, just making 1% if you're lucky per annum. That's just not who I am. So I've always been a bit of a risk taker, I guess. And and that was up to the age of 14, 15. And then after that I went on to study economics. I really enjoyed economics. I studied that with my A levels. I did my degree. I did a degree at Oxford, so I majored in economics at Oxford, and then went into financial markets after that and I've been in financial markets ever since.
Tell me about more about this. So this is interesting. You mentioned you never like to keep your money in your bank account. You want to invest it, like do something productive with it. How do you balance risk and trying to grow your capital at the same time? Because you don't want to lose like all your savings that you have, but you also want to be able to grow it. So how do you manage the risk and the returns you want to make on the capital?
Yeah, I mean, that's a really good question. And that's been I would say that's been a challenge for a lot of my life. That's what's, often, you have these kind of interviews and people, you get asked, what are the greatest challenges you've had in your kind of career or in your investing career or your financial markets career? Where do the challenges come? And one of mine is reining in risk, is reining in my natural, overtly appetite for risk. For me, I'd always rather, I'd rather put money to work than have money sitting in a bond, or, in a savings account, as I say. So that has been a massive challenge in my life. And then just to go to one extra step in here, and I've talked about this openly on other interviews that I've done. So I'm a recovered alcoholic. Okay, so I'm 15 years in recovery, and I look back on my life now, and my life has been around my kind of battles with addiction, and that has definitely surfaced in the financial markets and in trading and investing, and I have to be very, very careful and cognitive of how I approach anything that can have an addictive aspect to it. And that's also part of why I'm a risk taker. That's all part of my makeup and my personality. So I have to be very, very careful with that. I've had, I'm sure we can go on and talk about this, but I've had some very, very negative experiences. Yeah, everyone likes to talk about their positive experiences, but I've had some very, very negative experiences with me becoming too addicted on the trading side of things, and then as a consequence of that, then taking too much risk, with the addiction, and then that putting me in a very kind of dangerous place, from a financial perspective, and also from a social and personal perspective. I could have lost my marriage, through kind of overexposure to addiction, so, but we can go and talk a lot more about that. I'm happy to talk about that. So for me, what I do now is my recovery from my addictions has been based around and I don't know how much you and the viewers will know about, there's the 12-step recovery process. Okay, so I've done the 12-step recovery process for my addiction to alcohol and various other things, right? So I kind of apply that as well to now my approach to financial markets, to trading, and to risk management. So that's my kind of process of dealing with that and making sure that I am not in a position where I jeopardize not only my lifestyle and my life, and but also that of I have a family as well. I'm 53. I have a maturing family. I had 3 sons between the ages of 18 and 22. Happily married most of the time, and it's a matter of I'm not just doing this for me, and I've got to have that risk management in place for them as well.
Tell me a bit more about your sort of institutional background of like working with banks, and then how that led you to kind of create things of your own after.
The background is, so I went straight from, I majored in economics, Oxford, came out from the university and was looking for jobs with investment banks. And that didn't quite work out at first, but then I had a friend who was working on the London International Financial Futures Exchange, which is called LIFE. The acronym was LIFE, which still exists digitally now, but that was a real exchange. And it's the equivalent of the Chicago Mercantile Exchange or the Chicago Board of Trade when those were physical exchanges. So it was the European version where you could trade the FTSE 100, where you could trade short-term interest rate products, the short sterling product, Euribor, the Eurodollar, various different products you could trade. The Bund contract was traded there. And so I went down there as a broker, as a junior, first of all, as a trainee broker. We were called yellow jackets. We used to wear a yellow jacket. And it was in the pits where everyone was shouting and screaming and doing the hand signals. And so that's where I started my career. So I started my career at a fairly small broker called Discount Corporation. Moved on to various other brokers. I went to a broker called Cargill, which is a huge actually producer, agricultural producer. I worked for them, and I started to learn my trade as a broker and to learn about financial futures, and learn a lot more in depth about the markets. I think a lot of people come out of, maybe university with a business degree or an economics degree. And okay, that gives you a very low base of understanding of financial markets. But as you'll know, Etienne, the actual real understanding of markets and trading is to be really in it and experiencing it. And that was like, I was experiencing it, up close on a trading floor. And I think what's interesting to say about that is, I eventually moved on to Merrill Lynch, Bank of America. But I think the interesting thing about the trading floor, we often talk about emotions in markets and the psychology of markets, right? Well, when you actually have a physical trading floor and you're physically trading there, you see it physically in front of you. You see it with your eyes. You can hear it with your ears. When a big event happens, non-farm payroll, it's still big now. It was massive back then, right? When that event happens, there's a heightened atmosphere. There's a build up to the event, right? You can feel it in the air. You can hear it. The market then goes quiet and then it explodes in noise, right? So you hear the noise. Then the dealer board lights up, right? You're stuck in front of a dealer board. All the lights light up. There's no ringing of phones. They're just lighting up to say people want to trade. And you're hitting the buttons. You're picking up maybe 2 phones at the same time. There's thousands of people in there, like 2,000 people on the trading floor, all doing the same thing, trying to talk on maybe 3 phones at the same time, throwing in hand signals. So you see when they pick up the phone and the guy wants to get his order in quick, right? When you physically had to get an order in like that, he'd be shouting and screaming at you. He'd be swearing at you, right? And then that would, agitate you as the broker. You'd be then agitated at the guy in the pit, the trader. He'd be agitated when he's doing the trades with the other traders. And so, that emotion transfers from some guy who could be, he could be in, I don't know, he could be in the US and we were in London, right? Down the phone, his emotion transfers to me, transfers to the guy in the pit, transfers to the other guy in the pit. So you feel that you feel that transfer of emotion, right? And that was for me my real first experience, I guess, of kind of economics and markets being far more psychological and emotional than I ever kind of anticipated and realized. Because for me, it was all about, I've got a very scientific head. So it was all about analysis and looking at markets and being very method, and having a lot of method, having a lot of logic, where I could see that markets were more than that, much more than that, because you could see it and feel it in front of you.
I imagine the way people do trading now with like charts and technologies and everything is maybe different from back then, or different from the pits for sure. It's a different kind of trading that people do. Is it like something you've applied, or are you still like focusing on technical only, or how do you kind of do it so far?
Well, back then there was far less, I would say, technical trading. Those guys in the pits were very much so at that point I was still a broker. I wasn't trading, right? So, but those guys in the pits who were trading, they did come in and they would take out their like pivot levels. They would write them down on their cards, and they would have certain levels that they were watching, and they knew that around those levels there would be stops. The institutions would have stops placed, and they would be searching out to try and trigger those stops. Okay, so there was a technical aspect of it, but a lot of it is very instinct, is very gut orientated, right? So people are just kind of seeing the emotion, seeing the panic, seeing the worry, and following the price action. So it's far more price action driven, but they were respecting the levels. What I found, though, is there were very few brokers at that time doing much analysis on the technical side. So I used to do a lot of analysis, technical analysis as a broker. And that kind of then allowed me to move my career. So as we got to the end of the last century, in the late 90s, the electronic trading platforms took over. The pits end up disappearing, and we don't really have those anymore. We see them here and there, but they're not really doing any kind of volume. There are a few physical markets still around, but most stuff now is all electronic and is all online, obviously. And so I kind of moved then, because I've been using technical analysis with my broking, I kind of moved across and used technical analysis then, and to actually forge a new career. So from the end of the last century, in the late 90s, I became a technical analyst. I joined the research department. It was then Merrill Lynch to become Merrill Lynch Bank of America. And I spent 15 years in total at Merrill Lynch Bank of America, and through to 2008, so basically through the global financial crisis, when Merrill Lynch Bank of America merged. Then my career took me to Credit Suisse, where I actually ran the foreign exchange technical analysis department. We had like at one point, I think 10 people just working on technical analysis research within Credit Suisse. And we had like a 2-3 man team on the FX side. So we were covering FX technical analysis. And I ran that department. And so, yeah, that has always been the core of my approach to markets, has been analyzing charts.
So when you say analyzing charts, what is something you look at? Like, is it the same thing people hear about online that they learn about, or is it like different things you tend to look at?
You know what? It's a really good question, because I've gone through a whole journey from when I started. My mentor, he's a great technical analyst called Tom Hobson, and he's no longer with us. He passed away. But he taught me to kind of keep it, his mantra was very much keep it simple, stupid. The KISS, KISS, keep it simple, stupid. And that was his mantra. And we used to use various indicators. We used to use like ADX and DMI, which people weren't really using then. We used a lot of the normal indicators, RSI and stochastic. But then we would also then have, basically trend following, and a lot of Fibonacci as well we used to use. And then as I kind of moved on with my career, I kind of got more and more complex with my analysis. I added in lots of new fancy indicators. I was always on the search for new indicators, and my analysis got more and more and more and more complex. And then what I realized is when I then started to break down that analysis, I realized that I was doing, and there's the phrase, paralysis, analysis paralysis, right? And I was just doing so much over analysis that I was getting too many conflicting signals. And this was whilst I was still a research analyst. But I was also at that point doing it for my own kind of, I would say, short-term investing, long-term trading. Because at this point, it was still very much prohibited whilst I was working at the banks from trading, okay? So, but you could do like kind of long-term trading, short-term investing. You could kind of do that. So my analysis was getting paralyzed because I was looking at too much and made it too complex. So what I ended up doing around that kind of time, around I guess 2010 through 2012 at my latter stages when I was at Credit Suisse. And then subsequently, I stripped everything right back and I took it real down to basics, to basic trend lines, higher highs, higher lows, lower highs, impulse level, Dow theory, just very much following price action, following trend, identifying trend. It comes to a point when you've looked at charts. I've been looking at charts pretty much every day for the last, every trading day for like the last 30 plus years, right? Since the early 1990s. And, you get to look at, I almost don't need to look at an indicator for it to tell me whether the market's overbought or oversold, right? I can almost look at a chart and say, well, I can almost see where the Fibonacci retracement levels are. It becomes that you look at the stuff so long. It's like a sportsman who's been in the game a very, very long time, right? You just get a natural instinct for it. And it doesn't mean that I don't draw the lines on. It doesn't mean that I don't put the Fibonacci on. But, it almost becomes intuitive. It becomes built within you. Some of that analysis is already being done. So what I found was then when I did start trading for myself, far more aggressively, I could almost just strip back the analysis to the point of just being able to look at the chart. Almost the analysis was happening in my head, kind of stuff, and then making trading decisions. And that went really, really well for quite some time over the last 10 years. Unfortunately, it didn't all go well, and I can come to that story maybe a little bit later or maybe next.
A lot of people feel like if you're too simple, then you don't have an edge in the market because other people could be doing the same thing and it's too simple.
I don't think that's the case at all. I mean, maybe it is the case in that because maybe I'm doing analysis that I don't even know I'm doing. I've been working with an AI company for about the last 5-6 years, and they've asked me to tell them how I make a decision on my analysis. And it's like, so I just kind of try to tell them, but a lot of it is like inbuilt within me. So it's kind of, it's not just what I'm seeing on the chart. It's not just why the trend line, why on this instance do you think the trend line's going to break? And why in this instance do you think the trend line's going to hold? Well, you know what? Sometimes I can't actually tell you why, right? Because basically the analysis is happening within me and it becomes a little bit like gut feel, right? So I'm not kind of trying to avoid the question, but for me, I think simplicity really, really helps. But there may be that there's a complexity to my analysis that I don't even realize because it's become so ingrained within me.
But I think you're right. It's a good point. Every trader over time kind of picks up some things that they might not know about too much. They cannot really explain, but they know like some subtleties, some nuances in the market, and that helps them to trade better. So
Yeah, 100%. And then also on that, just to say, just to pick up on that point, I think there's an element as well for me when I've taught financial markets, I've taught technical analysis on and off for the last 10, 12 years. I've been like the academic dean of a couple of academies. And, what I always say to people is there will be some things that resonate with you. Yeah. That when some people I teach candlesticks to and they're like, oh, I don't get that. That's crazy. Doesn't mean anything to me. Sometimes you teach Fibonacci and people are like, Fibonacci. Yeah, that really works for me. There are some things I think that we naturally gravitate towards. And what I always encourage people to do is that if there's a reason that you're gravitating towards something, is that there's a reason you like certain things. There's probably a reason for that you don't even know why, right? And it's maybe something within you. And I think it's always easier to kind of use things. And let's face it, there's hundreds of different things we can use, hundreds of different tools at our disposal, right? It's like a chess game. You're trying to piece together the right pieces to come out with a winning solution, right? And I think what it is important is to try and pick those things that it's not necessarily things that are easy, but it's things that for whatever reason, like sit with you personally, and you feel comfortable in your understanding, and you also feel that that you have a resonance with, and a vibration with, almost kind of thing. And for me, that the big one has always been Fibonacci. For whatever reason, and Fibonacci is almost built into our DNA, right? It's based on the golden ratio, right? Which you see throughout nature. It's literally within us. And for me, that really resonated. And I've always used Fibonacci in my analysis, and I still do. And that's one thing that I've always stuck with, and it always still, when I ever do it, I put a retracement on and I see the market bounce right off the retracement. I'm still, even today, after doing it for 30 years, I still get excited and I'm still get like, oh, I can't believe it works. It keeps working, right? So, and it gives me, there's a smile on my face every time it happens, because it kind of surprises me, and I shouldn't be surprised because I've seen it happen so many times.
That's interesting. That's pretty cool. I know people who would hate Fibonacci, some people would love it. So it depends. It's definitely a personality thing, and it's good to stick to it. And I think the key is being open-minded, because people will say, oh, this one doesn't work, this one works. But it's just based on like what works for them and what doesn't work for them.
Yeah, 100%. I think open-minded is the right thing there. If there's one thing that being on this planet 53 years has told me, is to don't close your eyes, right? And to keep moving forward. I mean, I'm, at 53, I'm still learning. I'm still keen to learn. I say I'm working with these guys on AI. I don't want to be that old granddad in the corner saying no to technology, right? I always have the latest technology. I try to keep up with, current trends. And, I think, open-mindedness is a critical, it's one of the open-mindedness is actually is one of like the cornerstones of AA, is open-mindedness. You need to be open to possibilities. It's a big world out there and things are changing all the time. So I mean, if there's one thing I would say to traders, is, don't shut yourself off to anything. Go with what works for you individually, but keep an open mind. There's always something else to learn. There's always something else to look at.
So tell me what happens next. You traded this for a couple of years now. What's new since then?
Yeah, so I mean, I've been, since I left the investment banking world, I kind of moved into, I kind of continued as an analyst, and so I started to sell all the reports that I used to produce. I used to sell those back to people that I knew in the industry. So that would be hedge funds, that would be institutional brokers, that would be investment banks, traders and brokers at investment banks, and high net worth individuals. So to all of those, and real money accounts as well. So to those actual proper end users, and particularly in the commodity markets. So I had these relationships. So I forged a business which I called Market Chartist. And that was a technical analysis product. and still is, and that's still going. And so I, write reports, technical analysis reports. And so that's been like, that was like my baby, and that was the core of what I've done since I left the investment banking world about, it was 2012. So over 10 years now, coming up to 11 years. But then more recently what I've done, and then I moved and I was able to trade. So, and I said I'd come back to this. So having traded, what I probably did incorrectly is my kind of sweet spot, as an analyst, most of our clients, when you're an investment bank, and the big clients that we wanted to service would be the hedge fund community. And the hedge fund community is not day trading, but then equally they're not investing, right? They're in between that. And typically their holding periods would be maybe a few days out to maybe a few weeks, right? So that's kind of their kind of investment time horizon, or their trading time horizon. And so a lot of my processes I built up, and my understanding of markets or how I was presenting was built up around those time frames. But then when I kind of started trading, I kind of tried to start off on those kind of time frames. So we would call that, swing trading or position trading, right? So that's kind of how I kind of started off. But unfortunately, with this kind of addictive side to my personality, I wanted more and more, quicker and quicker, right? And so the emotion overtook me. And the risk management started getting pushed to one side, and I started trading very aggressively, very, very short term, so very intraday, day trading, and in and out maybe within minutes, and certainly not holding position for more than like 20-30 minutes, so becoming very, very short term. And as much as I was very, very successful at doing that, with those successes greed became an issue, and those successes became huge successes, and then they also became huge failures as well. And it's not easy for me to say that, but I will say that because I had basically switched to a time horizon that psychologically and emotionally I could not handle. So having gone through a very unpleasant experience with making huge amounts and losing huge amounts, what I decided was I stepped back and decided that, and identified the problem. The problem was my emotions and psychology were getting in the way. The strategy was working, but that it wasn't working, and I couldn't combine the emotions and psychology with that short-term strategy. What I could do though is zoom back out and go back to doing what I was doing really with the banks when I was advising the hedge funds, and is that I found that when I then traded from a swing trade, position trade point of view, so holding trades for maybe a few days or maybe 1 to 2 weeks even, right? Then what I did find is that I could do all my analysis. My analysis was better because I was used to doing that, and also psychologically and emotionally it was far easier for me to handle, because when you're day trading, you have the pressure is on constantly, right? It's constantly there, and if you allow that pressure to build, then it can become overwhelming, and the psychology and the emotions can overtake you. The strategy then got pushed to one side, and then what happens is potential disaster, right? And then I love the phrase that I'd never heard of it until I got involved with the retail side of the business, but, traders going on tilt, because people don't go on tilt at investment banks. I can tell you, if you go on tilt at an investment bank, you're out the door very, very quickly, right? So people don't go on tilt. But I experienced what that was like. So what I did is I dialed back. And so now what I do is I approach markets from a slightly longer time frame. It's still, I'm very, very active, but it means that it takes that kind of psychological, emotional pressure just off a little bit, right? And it means then that I'm more true to and stay with my analysis, and that works better for me. It does mean, obviously, if you're trading over a longer time period, there are effectively what you're doing is decreasing the potential volatility, which means then the opportunities are slightly less, and so your potential rewards are less, right? There's more rewards if you're trading in and out every minute, potentially, because effectively you're just giving yourself more and more and more and more time and more opportunities. However, that doesn't work for me. I think we all need to as you said, you have to be open-minded. You have to be willing to change. You have to be willing to adapt. And I had to adapt to more that kind of strategy. And so that's where I am now. The other thing that I've done, and the mini sales pitch, is the last 2 years with one of my oldest friends who actually met on the trading floor. Within about a year of working on the floor, I met James Thorpe. He's my partner in Trade Day. So we set up Trade Day about 2 years ago. We worked on it from about 3 years ago, from the end of COVID. Took about a year to get it into place, and then we launched a couple of years ago. So now, most of my time is devoted outside of the trading. I still have market chartists running, so we still have the technical analysis reports. And then what I have is we have Trade Day which is a futures funding company, prop trading company, we're in that space, and that's going really, really well. And what I really like about it is I feel that all of this 30 years of not only knowledge on markets, but also that experience, that emotional experience through all of this as well. When I went through my addiction recovery, I trained as a counselor. So I'm a trained and qualified counselor. So I feel that now I can bring a lot of that kind of that counseling, a lot of that kind of psychological and emotional experience that I've had with markets to be able to share with. And we share that with our traders at Trade Day. We have one-to-one mentoring on our higher tiers at Trade Day. So I'm able to share those kind of experiences. And most traders come to me. They don't want help with their technical analysis. They don't want help with their strategy. What they want help with is, how do I not go on tilt? How, when I have gone on tilt, do I get back and start trading? How do I run my profits and cut my losses? How do I stick to my stop loss? How do I, when it hits T1, how have I got the strength? What do I do to allow it to run to T2 and not just quickly take the profit? I think, for retail traders, it's very hard to do that, to let those profits run, and to also to not be, strict with their stop losses, and to try and help them. And there's various techniques that I suggest to them, and, we go through on these mentoring sessions that can help them maybe, and these are cognitive and behavioral techniques that I've learned through counseling that can help them, not go until, and to maybe, to access their profits and push and extend their profits, and also then to be able to be more strict with themselves on the stop loss side.
It's good to talk about this because I know a lot of people who day trade and they feel like they have to day trade because they want to have the quick returns, the like many trades a day, like making a lot of money every day. And then they do it. They force themselves to try to make it work, even though it doesn't work for them. They go back, then they might go swing trading for a while, then they go back day trading, but they don't figure out that it's not made for them. They have to maybe change time frame, do something different, but they are like stuck to that idea of day trading and they want to make it work. So
social media is wonderful in lots of ways, but then in some ways, it backfires as well, because people see the success stories, they see the word day trader, right? And, they're looking for the dream. We've been very much, since I've been out of the institutional environment, and since I've been more working with retail and the man on the street, I've really tried to not sell the dream, right? There's too many people in this space selling dreams, right? And yes, there's a nice lifestyle to be had. Yes, there's potential profits, but it's not for everyone. Not everyone's going to succeed for a start, because we don't all, we all can't be superstar, sportsmen. We all can't, or sports ladies. We all can't be pop stars. I can't sing. I can't be a pop star, right? Or I'm actually saying that these days, you don't have to sing to be a pop star sometimes. But, we all have our abilities. And so for some people, the natural, and it's not about intelligence, a lot of the best traders I know are not necessarily, they're not like been the best student at school. If it was about intelligence, all the smartest people on the planet would be trading and be multi-billionaires, and they're not, because it's not intelligence. It's the combination of intelligence, emotional management, risk management, psychology, what makes us up. And as you say, I think it's a really good point, Etienne. It's not day trading. People think, oh, it's trading. They're the same thing. It's not. An investment manager who runs a portfolio investing in global stocks, bonds, cash, commodity markets cannot necessarily then take that skill set and apply it to being a day trader, right? A guy at a hedge fund can't take his skill set and be maybe a day trader or be an investment portfolio manager. They're all different. I think people feel that, if I'm an athlete, I can do everything. Well, no, athletes specialize, right? And it's the same. You can be in the investing community, and there's a very, very different skill set from being a swing position trader to maybe managing a portfolio to being a day trader to being, and even within day trading, if you're holding positions for 3 to 4 hours, maybe doing one trade a day, right? Compared to the guy who's taking 200 trades a day, right? Who's in and out, in and out, in and out. Those have different skill sets, different personality traits. We're all different. We all bring our baggage and our positive aspects from our personality with us. And it's trying to find what fits best. And I think it's a really good point you make to say that, Einstein said doing a definition of madness is doing the same thing over and over again and expecting different results, right? And you must see that all the time. I see that, sim, prop firm, personal account, keep going around, but trying the same strategy or just tweaking the same strategy. Maybe what's needed is I'm going to be a swing trader, and change my timeline, kind of stuff. And you might find that works for you a lot better.
What kind of time frame do you base yourself on for taking trades? Is it more like a daily chart? Is it someone trading more, or what do you kind of focus on?
Yeah, I mean, for me, right, I think it's madness not to start on a daily chart. That's how I was taught maybe. But, what's the harm? Even if you're trading minute to minute, right, there could be a massive level on the daily chart. If you've got a 1 minute chart or a 5 hour chart or a 4 hour chart up, there could be a trend line coming down from 3 months ago, right? So why not start on the daily chart? You can quickly zoom in, money's at risk, right? It's your capital at risk, do your due diligence. I would always start on the daily chart. And then what I tend to do then is get an idea of the bigger picture, the bigger levels. I would then step in and analyze it, maybe either a 4 or 2 hour chart, then to do another level of analysis, maybe drill down into some levels that are a bit closer to where, I'm looking to either enter the trade or put a stop. And then after that, when it comes to execution, I usually go into a 15 or 30 minute chart for the execution on the trade. But bearing in mind, these are trades that I'm holding for 2 to 3 to 4 days, maybe out to an extent of maybe 2 to 3 to 4 weeks kind of stuff. And for me, if I'm in a trade and it's going the right way, those trades, one of the best trades I ever had was I sold the euro 5, 6, 7 years ago, and it just kept going down and down and down and down. So all I kept doing is moving my stop, moving my target, moving my stop, moving my target. It almost got to the point where I wanted to be out of the trade. The trade was hugely profitable. I was pyramiding in, but pyramiding the right way. I was adding less and less exposure so I had most of my exposure on at the beginning. I was just getting very small increments, but the trade just looked good, and I liked the trade. One thing as a little tip that I say to traders that I mentor is, let's say you're short, right? And there is a natural tendency when you go towards a target to want to take off the short because you're hitting target. You might move your stop down, and there's an itchiness to click that mouse and book that profit, right? And so what I ask traders to do is I say to them, get a pretend gun like this. So you get your pretend gun and you put the pretend gun to your head. And then what you say to yourself is, would I go long here? Would I buy it and go long here? And most of the time, the market's falling. You're short, you're in the money. And most of the time, if you do this and say, would I go long here? The answer is no. There's no way that I would go long here. Well, if there's no way you would go long, why the hell are you buying back your short, right? The only reason you're buying back your short is because you want comfort. It's a psychological, for you, psychologically, it's I booked the profit. And then usually what happens is it carries on going down and down and down. And then you get a win, and then you're angry at yourself with the win because it carries on and to go further into profit. So this is just a little psychological trick. I do it with myself, and that keeps me in trades. And I've run, the best trade I ever had was shorted the euro. It fell something like 10 big figures, right? 10 big figures, so, and it was the best trade I've ever done, kind of stuff. And the reason for that is that I let the trade run, just let it run, and that ended up being for it was a 1 week trade that ended up running for like 4 or 5 months or something like that, because there was no reason to get out the trade. There was absolutely no reason. I kept moving the stop, move the target, move the stop, move the target, and then eventually I got stopped out when it reversed back higher, and I was more than happy.
Pretty cool stuff. We're going to cover that more in a different episode, maybe next time. That'll be cool to discuss. But I want to spend your time. Where people will connect with you or find out more about your work after this podcast? Where can they see what you do?
Oh, yeah. So the easiest way to go is go to Trade Day. So that's where most of my focus is these days, tradeday.com. You can email me, steve@tradeday.com. But go take a look at Trade Day. We're really trying to make a difference in that. And I don't want this to be a sales pitch, but, we genuinely set up Trade Day to find. James comes from a prop trading, the real prop trading community, right? He worked for one of the biggest, he worked for Mercury Derivatives, one of the biggest trading communities in the world. He ran and set up their whole China operation. They had offices in Shanghai, Beijing, and Wuhan before Wuhan was famous for something else, right? So he set up all their offices. They had hundreds of traders he had hundreds of traders trading under him, was managing all their risk. And the idea behind Trade Day was to bring that model across into the retail space and to give us many resources to try and, I can tell you, because I've been in these situations, the hedge fund guy thinks that the investment banker or the portfolio manager or the central bank has got a bit more information than him, right? And then the guy at the bank thinks that the hedge fund guy has got a bit more information. And if we go all the way down that ladder, at the bottom is the retail trader. And the retail trader feels that they've got not as much information as everyone else in the market, right? And we saw through everything that went on with GameStop, right? That the retail guy does have some power at times. Okay. So, but what the retail trader has managed to do is they have got very, very, very good at technical analysis, right? There's loads of information on the internet. There is lots of good information as well. And you can teach yourself to a very high level technical analysis. But I think there's other aspects that the retail trading community doesn't quite understand. And we try to bring that. So we bring daily webinars that we bring to Trade Day. I do a webinar every day. And even though I'm a technical analyst, I focus on the macro fundamentals because I feel that that's where our traders are lacking. We focus on the mentoring, the psychological, the emotional, the risk management. That's where I think it's much more difficult to learn that online for the retail guy. And we are genuinely looking for successful traders to fund them for the long run, not for the quick profit, but for the long run. And, so come to tradeday.com, send me an email, steve@tradeday.com, and I'll be happy to chat to you.
Awesome, I appreciate the advice you gave to my listeners. I think that was good stuff, and I appreciate that the thing you shared today and the stories and everything. If people can connect with you directly, I'll put a link below the podcast show notes, and people can check it out directly there. And I appreciate your advice you gave here, and hopefully you connect next time and discuss more about that stuff. Really cool.